Middle East tensions are flaring up again, oil prices rebound, lifting bond yields and reviving inflation concerns around the globe. Energy stocks are attracting fresh inflows, while Chinese technology stocks may start gaining investors' attention again thanks to massive government support for AI infrastructure in China and also attractive valuations compared to the US, Korean and Taiwanese peers that are today dealing with large swings and high volatility. So welcome to Swissquote's daily market talk. It's Thursday, 9th of July. I'm İpek Özkardeşkaya. We will talk about the latest market drivers and money flows. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So the latest news is not brilliant. The Middle East tensions are flaring up again. US President Donald Trump called the end of the ceasefire yesterday, and the US continued bombing Iran last night. Washington also revoked the recent easing on Iranian sanctions, meaning that Iran will not be able to sell tens of millions of barrels of its oil currently on sea, and Tehran said that it will launch a large-scale retaliatory operation against the US bases across the Gulf region. Meanwhile, Russia is now limiting some energy exports to avoid domestic energy shortages amid Ukrainian attacks on its energy facilities. What a wonderful world. So the latest turn of events in the Middle East reversed the short-term bearish outlook for oil prices. US crude rose up to 13% since last week's dip and is now testing the $75 per barrel level, which is also the 200-day moving average, to the upside, with increasing possibility of seeing the barrel reach and breach the $80 per barrel level. Brent crude, on the other hand, shortly traded above the $80 per barrel mark yesterday. Both are slightly lower today, but the short-term risks remain tilted to the upside. But the immediate upside pressure in oil prices could be less severe than the one we saw in the first weeks of the Iranian war. Because first, the markets just got used to the tensions there and the disruptions in the Strait of Hormuz. Therefore, the surprise effect is much less than the fresh news, and the overreaction from the global markets will also be limited. Second, a number of ships already transited through the Strait of Hormuz, delivering oil to key markets. A few days ago, remember, Saudi Arabia cut the price of its oil significantly for its Asian clients to get millions of barrels quickly absorbed by Asian markets. Third, we have seen the oil market go from supply shortage due to the geopolitical tensions to supply excess in a blink of an eye over the past 3 months, especially the past few weeks, meaning that as the tensions de-escalate and the traffic in the Strait of Hormuz is restored, oil will continue to flow and the prices will fall again. And last but not least, China seemingly has ample oil reserves and a pretty high pain threshold, as they waited weeks before starting to replenish their oil reserves. As the prices started to fall, they wouldn't jump in if prices were to rise again. But on the other hand, if the tensions in the Middle East prolong beyond a few weeks, it will mean trouble again. Because first, we don't know how much oil China is sitting on today and when the situation will get critical for them. That's a total suspense. Second, if Iran starts attacking the energy infrastructure across the neighboring Gulf countries, the long-term damage could reduce the supply outlook again and vanish the actual supply quickly. And third, the world's oil reserves plunged sharply in the first 3 months of the Iranian war, leaving the market with a much smaller cushion. So we can say that today we are somewhere close to the square one of the Iranian war, but this time we have some valuable experience on how quickly things could turn around. I think that the fact that midterms in the US are approaching will also encourage the United States and President Trump to find a rapid solution to avoid the further prolongation of the war. Not that the US cares about the war in Iran, but the president cares about energy prices into the November midterms. And it's nothing good that US gasoline prices are still 85% higher than where they were at the start of this year. The Fed, on the other hand, has made a major U-turn due to the rise in energy prices, from expecting a few rate cuts this year to projecting one or more rate hikes into the end of the year. And the Fed minutes released yesterday showed nothing but uncertainty among the FOMC members. There wasn't a clear policy path there. The minutes rather pointed at a wide wide range of scenarios for how the inflation in the US will evolve. Duh. At this point, no one really has a crystal ball to predict the complex geopolitics of the Middle East and how the resolution and how fast it could happen. So at the end of the day, it will all come down to how fast the US could restore stability in the region and keep oil prices in check. Good luck with that. So the global yields are reacting again to the latest jump in oil prices. The US 2-year yield that best captures the Fed expectations flirted with the June highs again above the 4.20% mark. A benchmark for the European 10-year yield rose 9 basis points yesterday to pass the 3% level, while the Japanese 10-year yield is slowly sailing toward the 2.90% mark, multi-decade high level. Rising yields are waiting on sentiment across the global financial markets. The German DAX and the French CAC 40 tanked more than 2% yesterday, while the Dow Jones Industrial Index in the US fell more than 1% as investors piled into the energy stocks for the second session in a row. The SPDR's energy fund, for example, rebounded more than 5% over the past 2 trading sessions, while the Nasdaq 100 outperformed the rest with a 0.27% gain as investors sought Refusion Technology heavy index on thinking that maybe the companies there are less exposed to the rising energy costs, at least in the immediate term. As such, chip makers gained. Broadcom jumped nearly 5% on the announcement of a $30 billion worth of a deal with Apple. Nvidia rallied 3.65% on news that China will allow the companies buy a small amount of H200 chips from Nvidia. Bloomberg, on the other hand, pointed at the fact that Nvidia has now become cheaper than many of the S&P 500 companies, including the chocolate company Hershey's. Indeed, Nvidia's PE ratio fell to 35 and the price-to-sales ratio slipped below 20 after the company saw its stock price retreat nearly 20% from the mid-May to early June. Today, Nvidia's stock price is around 13% lower than its May peak, and the valuations that I just cited are based on that level. Overall, the re-escalating in the Middle East tensions could hinder the ongoing rotation trade toward the non-technology pockets of the market, but the energy space and the laggers of the past few days could eventually see inflows return to them. That said, the chip makers need the AI spending to remain robust to benefit from another strong rally, and the latter is unfortunately compromised today. First, investors are uncomfortable with the big AI spending increasing the finance by debt, and the latest bond sale from Amazon came as a warning this week. The demand for the latest $25 billion worth of bond offering was just 1.6 times oversubscribed versus 4 times on average for the US high-grade corporate deals this year. Second, Hedgeye warns that the data center construction growth may be slowing, and that's outright negative news for the future revenue outlook for those who are involved in the construction of these data centers and those who are selling chips for these data centers. And third, the valuations are still very, very high even after the recent pullback that we saw across the technology stocks, whether we are talking about big technology or any kind of chip makers. Interestingly though, the technology outflows from US, South Korean and Taiwanese markets are benefiting to the Chinese big technology names, but very, very recently. So the Chinese technology has been diverging negatively from their global peers, remember, since the past 6 months and so. But Alibaba surged 12% yesterday's trading session on reports pointing to improving June quarter trends. It's been a while I've been waiting for the Chinese technology to perform well. So the question is, could the convergence continue? The answer is possibly. China is very serious in this technology war. The government recently rolled out a $295 billion worth of plan to fund AI build out in China, and the Chinese technology companies are trading with a notable discount to global peers. In numbers, Hang Seng's PE ratio is sitting around 12.62 level today with a price to sales ratio of 1.39 only. Yes, 1.39, while Nasdaq 100's PE ratio stands near 37, almost 3 times Hang Seng's, with a price to sales ratio above 6. That's more than 4 times Hang Seng. So the question today is whether the Chinese stocks could catch a good momentum again when the consumer health in China remains poor and the fierce competition among the Chinese technology makers continue to we're investors. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.